Hi, and welcome to this week's look at the major news stories affecting the market so far. And what are we going to cover today? Well, 4 topics as usual. And we're going to start with the Aussie dollar against the Japanese yen, and that's seeing a bit of price action. And then we're going to take a look at interest rates and our hikes over for now. Our hikes over in the US for good. What sort of impact is that having? Take a look at the S&P 500 and the so-called SantaRally, and will it be as buoyant at Christmas as Santa would like? And we'll finish off taking a look again at the oil price, particularly following the OPEC Plus meeting last week. So, first things first, and the Aussie dollar against the Japanese yen. The rate has fallen to an important support level. Thursday morning, the rate dropped to 95.2 yen per Aussie dollar, and that's the first time we've seen that level since late October. Why has that happened? Well, we had some negative news out re the Chinese economy, and the Hang Seng index in fact set its 2023 low on Wednesday. We also had on Wednesday some data out from Australia. That was the Australian GDP figure, and that showed the economy is growing slower than expected. So overall, those two combined, obviously the relationships China and Australia, not great news for the Aussie dollar. We've also got the backdrop at the moment of expectations now of interest rate rises in Japan. Obviously, we know full well the Japanese have sort of had a contrary monetary policy to pretty much anybody else for quite some time. But the thought has intensified that that is about to change. And in fact, the head of the Bank of Japan, Ueda, said earlier this week that the central bank has several options for targeting interest rates once short-term borrowing costs are out of negative territory. So again, does seem to be that the Japanese are going to change tack something quite drastically. Take a quick look at the chart and see what that shows us. Well, we've reached important support, the lower border of the channel shown in blue. The rate has broken through the level 96.25, which may well now act as resistance against a turnaround. The RSI has also dropped to extreme oversold zone, which can tempt bears into taking their profits. So no real clear indication there. We could be prone to a short-term bullish correction after this strong downward impulse. That's sort of what it would seem to indicate. But if the current fundamental background, of potential changes in Japanese monetary policy, if that doesn't change, or in fact that intensifies, it's possible the yen may break through that important support level in December. So it certainly looks like there could be a time of volatility ahead, so don't forget your risk management techniques. Okay. And we've obviously mentioned interest rates and perhaps a change in monetary policy from Japan in terms of its own cross rates. Now we're going to take a look at the US in particular, and will rate hikes end when 2023 ends? A Wednesday morning saw some mainstream media speculation. The Fed is finally looking at making no further rate rises in 2024. Rate rises potentially off the table. And we haven't seen one since July anyway, so there's a feeling in the market that we may not see one by the end of this year. Looks like that could be true. Obviously, that is pure speculation. Nobody knows for sure. This is mainstream media talking about what they feel the sentiment of the Fed is. And though it's based on sentiment and no factual statements, normally that does have some form of impact. And the markets have responded slightly, but rather than a surge in the dollar as perhaps we may have expected with talk of no further rate rises at all, it's in fact the pound that's been on a bit of a run recently. Between November the 9th and December the 1st, the pound went from 1.2290 versus the US dollar to 1.27, and that's a pretty significant gain for such a major pair, where we'd often consider a 1 cent increase or decrease a major move. Now, it shows a combination, I think, of fortitude in the British economy, and also perhaps the fact that investors are waiting for facts these days rather than conjecture and speculation, as we have seen historically to some degree. Something a bit more, cement-like than just the media thinks the Fed may be changing its sentiment. Now, obviously, interest rates increases are aimed to curb spending, but they do put additional pressure on people with mortgages and loans, for example, and also on large corporations who have to pay more to service their commercial finance agreements. We've seen this before. Think of a bit of a credit crunch. Obviously, increase interest rates. If you have a mortgage, as many people in the world do of some form or another, it's going to cost you a lot more. People have less money to spend, and in fact, are we getting to a point where they're running out of money? So the US government's got to be very, very careful here, and it certainly wants to avoid any sort of credit issue like we saw back in 2008, for example. We don't want to be in that situation again. So the pound's strength over the last week or so is interesting. As I said, speculation doesn't now seem to be a bit of a gauge for the market, and changes in US monetary policy, or potential changes, should we say, not having quite the same effect. The fact the dollar's been strong for a long time, despite bank collapses, geopolitical issues that we've seen, may be coming into play here, maybe sort of a rebalancing, but it's still all up in the air. The volatility does seem to have tailed off a little bit from the values at the end of last week, but the price is still pretty high compared to what we've been seeing over the last couple of years, and we haven't been here for a few months now, so lots going on out there. Be interesting to see much more talk from the Fed or about the Fed, if that has an impact moving forwards. Okay, now we're going to turn our attention to indices, and we can take a look at the S&P 500. And this year it looks like Santa may have problems rallying the market. Now, traditionally it's believed that the SantaRally occurs end of December and the first few days of January. It's something you can look back on historically on the charts, and obviously because of the time of year it's got this quite cute, I suppose, name. But many think it begins earlier. We take a look at so far this month. The start of December, the S&P came close to the high of year, about 4,611, but has declined since. The candle on November the 29th has a very long upper shadow. Now that's a sign of seller activity, and we saw exactly the same thing on Wednesday. The candles on December the 1st to the 4th are forming a bearish engulfing pattern. In fact, all of the listed candles show a head and shoulders pattern. They're labelled SHS in letters. So the chart is showing activation of sellers near the high of the year, and that's a bit of a problem for a SantaRally. If we look, the channel in blue actualises the theme associated with this rally. The strength may not seem to be there quite as much as usual. Now, we've mentioned the signs give reason to possibly assume that the price may roll back to the lower border of that parallel channel and approach approximately that psychological level of 4,500, 4,500. Now, that provided support during the consolidation back in November the 15th to the 17th. So indications are that Santa may have a bit of a problem pushing the market higher for the rest of the month, but obviously there's some bigger factors than Santa at play here. Labour market data comes out on Friday. Now that could well serve as a trigger for a rollback, as we've just mentioned. On the other hand, of course, some particularly good data may well give impetus back to the bulls to attack the high of the year again and potentially reinstate a SantaRally. Before that data comes out on Friday, that's later in the afternoon Friday, it'd be interesting to see if the market has the ability to form a rebound line from the medium line of that blue channel. That perhaps will give us an early indication of what to expect. But plenty of facts at play as usual. Keep your eyes and ears open, and don't forget your risk management techniques. Okay, finally this week, we're going to take a look at the oil price again. I know we've covered it quite a lot lately, but there's been some pretty significant price action. In fact, WTIOil, the price has dropped to its lowest level since July of this year. Tuesday saw the price fall below $72.10 per barrel. And in fact, on Thursday, it's even lower than that figure. Now, fundamentally wise, that is due to US exports of oil increasing. In fact, the volume of those exports is approaching the record 6 million barrels per day level. Flows to Europe and Asia in particular are showing steady growth, less of a reliance on the OPEC plus countries. Now, talking about OPEC plus, obviously we did have the meeting last week and they agreed to cut production by 1 million barrels per day. Now, those production cuts, it seems as though they've possibly been priced into the market already, because it didn't seem to have such a massive effect, or the fact that market participants aren't confident that the cut will be fully implemented. We said before, the meeting had already been postponed or rolled over because some members of OPEC Plus were not keen on production cuts. Will they actually come fully to fruition? Now, it's clear that those production cuts haven't had the desired impact for OPEC Plus member countries. The price hasn't gone up. And in fact, we have Vladimir Putin in the UAE and Saudi Arabia currently. Could well be discussions thus about further cuts. And Deputy Prime Minister Novak said that OPEC Plus is already ready to deepen cuts in Q1 2024 to eliminate the speculation and volatility if the current measures are not enough. It's already being spoken about. So seems to be some belief from OPEC Plus countries that the latest production cuts aren't going to have the impact they wanted. If we take a look at it from a technical point of view, the price continues to develop dynamics within the descending channel, which is shown in red. The rising channel, which we're showing in blue, looks like it could be an intermediate correction within that larger decline. The lower border of the parallel channel may well provide support for the current decline moving forwards. Updates to the lows earlier in the week were relatively small and did begin to give the appearance or look a little like a false breakout of the November low and sort of indicated that bears seem unsure. But as I say, it's worth noting that we're talking about price action Tuesday. On Thursday, price circa the $70.40 a barrel, so below that parallel blue channel lower boundary. Now, as ever with oil, there are an awful lot of factors in play. The market seems to want that price down lower, but it is fair to say the majority of producers want that price higher. May not be immediate, maybe into the new year, but I think we're going to see some further action. We wish you luck with your trading in the week ahead. Bye for now.